Welcome back. So today we're tackling a topic that, honestly, it usually makes accountants sweat a bit, but it's actually incredibly fascinating once you break it down. We're talking about financial guarantees under Ind AS 109. Okay, let's dive right into this. We're going to trace the exact life cycle of a financial guarantee, taking it step by step from day one all the way to maturity.
Here's our roadmap for this explainer. First, defining financial guarantees. Second, initial recognition at fair value. Third, subsequent measurement. And finally, number 4, accounting at maturity. Let's get to it.
Starting with part 1, defining financial guarantees, the promise and the liability. So, what exactly is a financial guarantee? Well, simply put, it's a contractual obligation, a liability, to pay the bank if a borrower defaults on their loan. Now, the absolutely crucial word here is liability. Why? Because the very second you make that promise, you're taking on a real, tangible risk of a future cash outflow if things go south. Under Ind AS 109, a friendly little handshake, that doesn't exist. It's a measurable financial commitment. You are literally putting your own balance sheet on the line.
To make this concrete, let's use a classic father-son analogy. Imagine A Limited is the parent company, the father, and B Limited is the subsidiary, the son. Now, the son, B Limited, needs a loan from the bank. But the bank, they're kind of nervous about his creditworthiness. So to lower the risk, they demand a guarantee. A Limited steps up and says, hey, don't worry, if my son doesn't pay, I've got it. Obviously, A Limited is doing B Limited a massive favor here. But in the world of Ind AS 109, favors aren't free. This entire transaction has to be quantified and actually recorded as a liability in the father's books.
Which brings us to part 2, initial recognition at fair value, or as I like to call it, quantifying the favor.
Now, what's really interesting about this is the stark contrast it creates for the subsidiary's borrowing costs. Think about it. Without the parent's guarantee, the bank looks at the subsidiary, sees the risk, and demands a 10% interest rate. But with that guarantee in place, suddenly the bank feels a whole lot more secure and boom, the rate drops to 8%. So the guarantee tangibly, measurably drops the interest rate. And honestly, that drop is the entire reason the guarantee was issued in the first place. So that leaves us with a very critical number, 2%. That 2% difference isn't just some fun trivia. It is the annual interest saving for the borrower. And under Ind AS 109, this 2% saving actually represents the true fair value of the guarantee. Let that sink in. The parent company's promise literally has a value equal to the cash it saves the subsidiary every single year of the loan. It's just a brilliantly logical way to put a concrete number on what would otherwise be a totally abstract promise. All right, let's look at how we actually build this into an accounting calculation to find our day one liability number. Step 1, you calculate that annual interest saving, which in our example is 2% of the total loan amount. Step 2, you figure out how many years are left on the loan tenure. And step 3, and this is the big one, you calculate the present value, or PV, of all those future savings. But right here, you absolutely must use the 10% rate, the interest rate without the guarantee, to discount those savings back to present value. Why? Well, because we're valuing the guarantee itself, we have to look at it from the perspective of standalone risk. If you use the 8% rate, you'd basically be diluting the true value of the favor. Okay, so we've got our present value number. How do we actually book the initial journal entry? Well, we credit the financial guarantee liability account at that exact present value of the interest savings we just calculated. But what do we debit? That actually depends on who you're helping out. If you're doing this massive favor for your subsidiary, it's treated like a capital contribution. You debit investment in subsidiary. It's essentially like injecting money into your kid's business to help them grow. But say you randomly guarantee a loan for a totally unrelated party, which, yeah, is rare, but it happens, you have to debit your profit and loss immediately as an expense. Why? Because you aren't building any direct equity value for yourself there. Moving right along to part 3, subsequent measurement explained, the higher of showdown. Now, you might be wondering, do accountants just leave that liability sitting there unchanged for the next 5 years? Absolutely not. At every single balance sheet date, they have to run a continuous showdown between 2 very specific metrics. In the left corner, we have the remaining PV. That's the present value of the unamortized remaining interest savings. Basically, the day one amount we calculated minus whatever time has already passed. And in the right corner, we have the expected credit loss, or ECL. Let's take a second to really define that second metric because it's vital. Expected credit loss, or ECL, is the estimated loss amount multiplied by the probability that the borrower will actually default. Think of it as your provision for bad news. It's a strict, hard-hitting reality check based on the borrower's current financial health. Look, if the subsidiary is suddenly struggling to make sales, that probability of default shoots straight up, and so does the ECL. So the crucial point here, the golden rule of subsequent measurements under Ind AS 109, is that you must record the liability at the higher of the remaining PV or the expected credit loss. It's the ultimate principle of conservatism. If the mathematical amortized value of your favor is higher, great, you use that. But if the actual real-world risk of you having to pay out of pocket, the ECL, spikes higher than the favor, you must immediately recognize that harsher reality on your balance sheet. You can't just hide behind your day one calculation if the real-world risk is escalating. Once you figure out that higher of amount, you have to account for the change. You basically compare your newly required liability to whatever carrying value is already sitting on your books. If the required liability goes down, maybe a year passed, or the subsidiary is crushing it and the ECL is super tiny, you record a gain in the P&L. On the flip side, if the liability increases because the ECL shot up, you record a loss in the P&L. It's a totally dynamic adjustment mirroring the actual real-time health of the borrower.
And finally, Part 4, Accounting at Maturity, the Climax and Resolution.
All right, the maturity date finally arrives. The suspense is building. The loan has reached its end, and literally the only question that matters right now is, did the borrower default? We essentially have two branching paths for our narrative climax here. Let's see how they play out. Let's start with scenario A, no default. This is the happy ending we all want. The subsidiary successfully pays off the bank loan entirely on its own. Because of this, absolutely no cash payment is required from the parent company. The guarantee is effectively over. You simply zero out your financial guarantee liability, and any remaining carrying value left in that liability account, it's happily transferred right to the P&L as a gain. The risk is gone, the obligation is fulfilled, and your balance sheet is squeaky clean. But then there's scenario B, the disaster scenario. The subsidiary goes broke and just can't pay. Suddenly, the bank is knocking on the parent company's door. The guarantor must now step up and pay the bank in hard cash. And this brilliantly illustrates why we did all that accounting in the first place. You debit the financial guarantee liability down to zero because the promise has now materialized into an actual event. Then you credit your bank account for the cash outflow. And if the cash you have to pay out is more than the liability you provisioned for, that bitter difference hits your P&L as a harsh loss. Which brings us to our final takeaway for this explainer. Ind AS 109 transforms hidden risks into visible numbers, ensuring that doing a favor never catches a balance sheet by surprise. By forcing companies to calculate the present value of interest savings and then constantly comparing it against expected credit losses, this standard completely strips away the illusion that guarantees are just paperwork. They aren't. They are real, heavy financial commitments. So next time your company considers guaranteeing a loan, you have to ask yourself, have we truly priced in the cost of this favor? Thank you so much for joining me today. Keep calculating, stay curious, and I'll catch you next time.